Welcome to this edition of Diligence Inside America's Boardrooms. I'm TK Kerstetter, and I'll be your host for today's show. We're going to be talking, about stakeholder capitalism. And it's going to be a little different today. The format's going to be a little different, but we want to sort of tackle why stakeholder capitalism will be sustainable even with existing hurdles and past failed attempts. And joining me is somebody that I feel is very qualified to sort of have this discussion with me. Please welcome Brian Stafford, who's the president and CEO of the Diligent Corporation. Welcome, Brian.
Hey, TK. Thanks so much for having me on.
So, in my mind, I've always been a proponent of stakeholder capitalism and have held major events on ESG, particularly diversity related, for many years in the roles that I've had. At the same time, I'm just a tad older than you, and I have lived through some interesting experiences, enough that I can sort of build a case that we've been close to this before and have fallen back into old ways. So for this unusual format, I'm going to play the devil's advocate here. And I'm going to make a case that this stakeholder-centric structure and stakeholder capitalism is no slam dunk. And you, my friend, are going to be the voice of reason and the defender of why stakeholder capitalism is here to stay. And we still have this gap where there's a number of directors that haven't bought on board to the concept, and you will say why, if they don't get on board, they might be late. They might miss the train and be left at the station. So, are you ready to take on that role?
I'm ready to take on that role, TK.
Okay, so let's first look back. Now, this necessarily wasn't the prime of your career, but in the 80s, there was the infamous barbarians at the gate. And the whole theory was that hostile takeovers were taking over companies that had value being broken apart. They would take over these companies, sell off pieces, close facilities, impact thousands and thousands of employees. And at that point, there was sensitivity that certainly was raised at that point, that this was not a good or sustainable practice and something had to be done about it. This was glamorized in a way by the movies at the time, which you may be familiar with, certainly Wall Street with Michael Douglas. And there was another great movie at the time called Other People's Money with Gregory Peck and Danny DeVito, where, again, all based on this sort of hostile takeover, don't worry about employees. The ultimate goal here is for somebody to make money. So anyway, the movement at the time was something had to happen. It sort of quickly dissipated when companies missed their whisper number and were hammered, by Wall Street, In addition to that, we saw pension funds that started to say, well, as long as I'm funded, meaning that I'm not falling behind as an underfunded pension fund, I'm probably okay with what's happening out there. And so really, we didn't see any change. We didn't see anybody sort of trying to balance major constituencies at that point in time. So, when I think about that, it brings me to another point, and that is, I mentioned that that there's a gap in the research, and then that showed how directors were buying on. Well, then the Business Roundtable made this announcement that they were going to revise the goal of corporations into a more stakeholder-centric role. And I think the initial reaction was good. But when somebody started to look into it, they found out that only a handful of the 181 CEOs had taken this issue to their board, and even less than that handful had actually changed anything in their corporate governance guidelines that were published in their website. So all of a sudden, people raised the issue: was this, somewhat of a way to take the pressure off, but that nobody's really buying onto that? So there was certainly some skepticism. And finally, as the devil's advocate in this, when you think about this stakeholder capitalism, and then you bring up other issues, particularly corporate law, we all know that the Delaware courts have always sort of centered a lot of their decisions on shareholder rights. And it seems like a lot of issues sort of push back to the shareholder-centric versus the stakeholder-centric. So, and Brian, I won't even get into the challenge of coordinating all of those issues, into strategic strategies that won't sacrifice returns. We might get to that later. But my simple question to you is, with all that being said, why will stakeholder capitalism survive this time around?
It's a great lead up, TK, and I appreciate you playing the devil's advocate role. To anyone who says that stakeholder capitalism isn't really the right way to look at things in the world, I would actually challenge them and say, I actually do not believe, for the folks who believe that that stakeholder capitalism is at odds with the more shareholder-centric view, I don't actually think that I don't think those people are thinking about things in the right way. Because if you actually think about things over a longer term perspective, you can't maximize value for your shareholders over time unless you think about your broader stakeholders. To your barbarians at the gate analogy, if your time horizon is 3 to 5 years, maybe it's straight up between two. But if your time horizon is much longer, if your time horizon is something akin to even the index funds, the BlackRocks, the State Streets of the world, you really need to take a 10, 15, 20-year view of your business and the shareholder, and that you can't maximize returns for the shareholder if you aren't focused on the communities that you operate in. You can't if you're not focused on your employee base, and if you're not focused on your clients. And the reality is making decisions that are good for your employees, for your communities that you operate, ultimately will benefit your shareholders longer term. I think where companies get into making the wrong choices, if exactly what you're mentioning, TK, if you're focused on the whisper number, if you're focused on hitting next quarterly earnings update, then you might make a trade-off in the way you think about investing this quarter versus next, as opposed to saying, what do I need to invest for the next 2, 3, 4, 5 years? And furthermore, I think there are two other trends that will make sure that stakeholder capitalism continues to scale in its importance. One of them is currently, if you look at the millennial and the demographics of our employees and buyers, they're much more skewing towards wanting to work for and buy from companies who long-term think about doing good, who think about doing good on their economy, doing good on your broader set of stakeholders. So I think you're going to find if you're only focused on hitting your number in your next quarterly earnings, you're going to leave the talented employees behind who don't want to work with you, and you're not going to generate the goodwill and the interest from consumers who want to buy goods from companies who are focused more long term on the stakeholders.
So, okay, I'm keeping my devil's advocate hat on. So I know that you've participated in some fascinating webinars where you were on a panel with world leaders from the World Economic Forum and the International Business Council, and talk a little bit about what kind of discussions you're hearing out of them, knowing that you've got to take ESG, corporate purpose, Wall Street, corporate law, all that, and mesh that together into corporate strategies. What are they? What type of motivation and outlook do they have relative to this task ahead of them, that you thought was interesting that you could share with the audience?
Yeah, I think that what I think you've seen from the Business Roundtable, the IBC, and other collections of CEOs from some of the largest organizations, is new ways to invest in their community and their environment in different ways than they ever had before. And you look at, an initiative by Bank of America and investing in local communities and jobs and in underrepresented minorities, particularly focused on the African American community here in the US. You're looking at companies who are making major investments in areas that will ultimately make the world a better place, and in turn, rise up their organization, set them up better for success. Or whether it's Goldman Sachs, who won't take a company public without at least one woman on the board. These are things where Goldman in part does that in order to be seen as reflective of the needs of Goldman's employee base, but also in all the companies out there who are looking to investment banks to go public. And I think you're seeing companies who are doing well while doing good. And I think that also creates people wanting to follow on and do more of that as well. And so I think you're finding different organizations who make those investments, who take that step forward. They're going to get the positive press. They're going to get, on balance, the employee who's deciding between two companies is going to go to that employee who's doing well. And you're seeing consumers actually vote with their pocketbook. So what I think you're seeing is an evolution of companies who are focused on stakeholders build a bit more momentum, and that momentum is hard to stop. And I think you'll see that continue in other companies following suit.
Well, taking my pleasant skeptic hat off for a moment, Brian, I think that, American businesses and even businesses worldwide are going to have to play a bigger role, and will play a bigger role in making all this happen. While government, and I think the Biden administration, will certainly be sensitive to stakeholder capitalism and the concepts of it, there's so much angst and separation and whatever. I think that we can't count on that. We have to count on American businesses. And I think the other thing that I will mention over the 30 plus years that I've been in this space is I think people are underestimating businesses a little bit and how philanthropic and sensitive they were in the past. I'm sure, again, there's outliers in every situation that you have, but I think if you talk to the core of those 181 CEOs that signed off on the Business Roundtable commitment, I think most of them get it. I think they understand the balance of major constituencies, and if they favor any one party, that creates an unbalance in long-term benefits for them.
Yeah, I think your point, TK, is a very, very good one, where you're looking at, the last 4+ years, not just in the U.S. but in other places around the globe, has been marked with more noise and rhetoric than long-term action or long-term development or long-term programs. And I think what you're seeing too, in parallel to that, maybe lack of leadership from government, you're seeing in parallel the rise of the multiple trillion-dollar market cap companies. And you're having organizations that actually have the scale, the power, the heft, and the leadership who actually aspires to invent, to invest, to make things ideally better. And you're actually seeing some of that void from government actually filled by business leaders. And I think there's an interesting question that's worth debating on, opining on, or debating at some point, which is if the political rhetoric changes, does the business community actually go back to, staying focused and putting their head down and just operating their business, or does that that voice for good, or that potential voice for good, does that maintain, or does it reside? And I think you'll find that it actually maintains, where boards historically were in a mode of asking the CEO to just not comment and just focus on doing the task at hand. Where I think you're seeing more and more boards being open to, if not encouraging in some cases, CEOs to actually take a stand, because taking a stand in a point actually does matter to employees, and it increasingly matters to consumers. Now, how you do it in the right way and how you get that balance, you could argue some CEOs go too far, but I think finding that, it's a very different mind or coaching kind of mindset from boards today than we might have seen kind of back in your Barbarians of the Gate, 20, 30 years ago. And I think ultimately, as I mentioned, I think the thing that keeps companies on the right footing, focused long term, and focused on your stakeholders as a way to enable shareholder returns, I think those companies and those boards will ultimately perform better. And I think boards actually have a unique role, where boards in many cases should outlast the CEO, or at least help the transition from one CEO to the next. And sometimes helping and coaching a CEO and saying, well, what should we be doing longer term? How should we be thinking longer term? Because ultimately the board, obviously in partnership with the CEO, should be ensuring in that company's long-term viability. If that company succeeds longer term, your shareholders will benefit much more than those who do not, and the companies that fail.
Well, I think it's certainly going to be an interesting year once we can refocus a little bit off the pandemic to see the energy that's centered around this. And I think we'll see businesses again try and prove that stakeholder capitalism does not sacrifice shareholder return. So anyway, Brian, I wanted to thank you for taking the time to join us, and appreciate again your views on the worldwide perspective of stakeholder capitalism.
Thank you very much, TK.
And that will conclude this edition of Inside America's Boardrooms. We hope you enjoyed the show. We'll be back again next week when we take another look at a critical topic that'll help you be a better board member or committee member. So we'll see you then.